What's up, ladies and gents? As you remember in last week's video, I mentioned I will make a little bit more of an in-depth video about the different business structures that you can have here in the United Kingdom. So if you remember, the three main business structures that you can have here are being a sole trader, a limited company, or a partnership. So for the purpose of today's video, we're going to treat sole traders and partners as very similar because many rules and many different aspects of both are very similar. The main difference is, of course, that as a sole trader, you are just one person. You can call yourself a freelancer. But when it comes to a partnership, it's obviously made of two or more people. So of course, when it comes to specifically what business structure should you actually take, well, it really depends as each case is different. It is really on a case-by-case basis. There are so many different aspects that you have to really take into account, but I did want to make a video to give you some kind of an idea, a guide, if you will, that you can sort of go off of and maybe think about what works for you best. So let's get into some of the things that you should be considering, and based on your answers and this video, you should know roughly what business structure should work for you best. So first and foremost, one of the questions you should ask yourself is, how long is this specific business or project going to be? If it is simply a one-off and you're only intending to do this for a couple of months, then maybe the best idea is to just simply stick through as a sole trader. Now, there of course are other things to consider, such as, are you the only person involved in this project, or are there more? Maybe a partnership will be better for you, or perhaps even setting up a company specifically for this project. However, if it is just one project and you don't necessarily intend to turn it into a business or continue doing it, it might not be the best idea to start a company, because the admin that it would take to actually start the company and the admin to actually run it might not necessarily be the best thing for you, because it will take a lot of effort. The second question you should ask yourself is, are you going to employ other people? And now I must iterate that what I mean by employment is that they are actually going to be your employees. You will be their employer, right? So this isn't simply working with freelancers or contractors. That's very different, because the way that they get paid and the way that they do work for you is very different. So are you actually providing a place of work? Are you becoming let's say, a boss for these people, or are they simply your contractors in a way? If you are intending to employ people, then it might be a good idea to set up a limited company. Now, one of the main differences between a limited company and being a sole trader is the way that you can access your money from the business. So when it comes to being self-employed, obviously what you earn, what you get from customers, minus all your expenses that are allowable for tax purposes, equals your profits. And those profits you will pay tax on, and the rest of the money is simply yours in your bank account. You can use it for whatever you want, right? For personal purposes. When it comes to a limited company, because it is a separate entity, that money has to be accounted for in a different way. So the way you would typically, as a shareholder, so that is the owner of the company, or the director, which is the steward of the company, someone who looks after the company's well-being, financial well-being, the employees, the running of the company. So the way you access the money from your company is very different. You can't simply take that money out just like that. You know, you still have access to it because it is your company, but you can access that money through either being employed by your own company as a director, for example, or you take the money out as dividends. So dividends are basically payments that are based on the amount of shares that you hold in your company. So after your company makes a profit and pays corporation tax on those profits, you can then distribute that profit to your shareholders. If you are the only shareholder, so owner of the company, then you get to keep all your profits. And whether you take the money out or not is your choice. You can leave it in the company, the tax has been paid. However, if you take that money out through dividends to your own personal tax account, let's just say, then you must account for dividend tax, which is a lot lower than what you would typically pay if you were simply self-employed. So just to give you an example, the basic rate band, which is typically 20% for normal income for employed people and self-employed people, well, on dividend income, it is only 7.5%. So as you can see, there is a big tax saving when it comes to that. The other main thing when it comes to saving on things like taxes when you're self-employed or if you're a limited company. So when you take dividends out from your company, if you have a limited company, the one thing you also don't pay is national insurance contributions. That is a huge saving because you typically pay 13.8% as an employer, so you as the company, plus 12% as you as the employee. So as you can see, that already adds up to a lot. You're paying national insurance contributions as an employer and employee, you're paying taxes. And there are just so many savings when it comes to tax that you can do when you have a company instead of being self-employed. But this only makes sense if you are a high income earner. And of course, with all those goodies when it comes to tax, all those different ways of taking money out, all those different treatments of things, well, it also means there is a lot more work involved in running a limited company. So typically people would get accountants. You don't necessarily have to if you want to manage your own finances. However, you have more obligations. You have to submit your company accounts. You have to submit your corporation tax returns. If you are VAT registered, you will have to send your VAT returns, but that can also be if you're self-employed, depending on whether you are over the threshold, right? So there are many different things you have to actually account for. So that is something to bear in mind. And I think one of the biggest differences between being self-employed or a limited company is the liability. So as a self-employed person or being in a partnership, well, you personally are liable for anything that goes on within your business. So that is, if you owe someone money, well, that is your personal liability. If you need to pay your suppliers, that is your personal liability. If you have let's say a mortgage, if you are a property owner, that is your personal liability. Or if you are in a partnership, obviously that liability is shared between the partners. However, if you are running your business through a limited company, that limited company is a separate legal entity. So all the liability for things that are related to this specific company are put through under the company. So you personally usually are not liable for any of these things, whether there is debt to any people you owe money to, or things like suppliers, or things like mortgages. It is all done under the company's name. So none of the shareholders, the owners of this company, have to be personally liable for it. Of course, there are certain exceptions. It depends what kind of contract you get into. Certain contracts might specify that you are personally liable. And also, if there is some criminal proceedings, well, there is a little bit of a gray area there because you might personally be liable to some things as the shareholder or the steward of the company. But that is really rare. The next thing is when it comes to expenses that you can claim under being self-employed or being a limited company, there is a lot of room when it comes to being a limited company. Typically, you could say that you can claim for more things, but maybe not necessarily that. It's just that there are different rules. However, when it comes to the self-employed, it's typically that you really have to prove that this is for your own purpose, wholly for your business, exclusively for your business, and it is a necessary cost for you to run your business. When it comes to the company, there is a little bit more of a gray area. Of course, you still have to abide by the rules, abide by tax law, but you can kind of get away with a few more things. With all that being said, being a limited company might not necessarily be the best thing for you. If you are planning to, for example, get a mortgage in the near future, it is typically easier to prove your income being self-employed because you would have your self-assessment than when you are running a company, especially if your limited company is just starting off and not doing essentially well, or you've got other owners, then it's a lot more difficult to get all the paperwork necessary to get your own personal mortgage. It's way easier if you are an employee or if you are self-employed or in a partnership, of course. Now, of course, all these things are really just touching the surface. There are so many different things, and like I did mention, that every case is different. It really depends on so many different aspects, but I hope that this video gives you somewhat an idea. And if you've got any questions, please feel free to just drop a comment down below. Leave a thumbs up if you did enjoy the video, and if you are enjoying these videos so far, I would highly appreciate you subscribing to my channel. And other than that, I will see you next week with another video. Peace and love.